Hello, everyone. This is Jim Martens, and welcome to our latest edition of Elliott Wave Traders Classroom. We recently received a question regarding Wave 4 and potential overlap with Wave 1 of the same degree. It's a basic question, but a great question, one that's asked regularly. I get this via email or during live events all the time. So first thing I always do is go back to Elliott Wave Principle by Frost and Prechter. Most questions like this are answered there, but sometimes the book and its black and white look at the markets might not fit the reality of markets. Usually, at least in my opinion, markets do adhere to the Wave Principle and to the rules and guidelines quite well. But there's always exceptions. And so that opens the door to the question about overlap between Wave 4 and 1. So let's dive in a little bit. In an impulse wave, Wave 4 should not overlap Wave 1. Now, sometimes you might read that to say cannot. Other times, I've heard it said Wave 4 should not or cannot end in the territory of Wave 1. And the literal interpretation would be that Wave 4 cannot enter the territory of Wave 1. And I'll forego talking about, well, what if Wave 2 is an expanded flat and Wave 4 dips into the area of Wave B of 2? Some folks would say, well, that's a ding against that count or a strike against that count. Others will argue, well, just because you enter the area of Wave B of 2, we're talking about Wave 2, not Wave 1. The overlap is with Wave 1, technically. So always keep those rules in mind and always work diligently to try to adhere to those rules. But even in Elliott Wave Principle, at least in past editions, I've been reading it since the early editions, in commodities especially, or in highly leveraged markets, it concedes that there might be overlap between 4 and 1, be it on a small degree of trend. So with highly leveraged markets and at a low degree of trend. Very rarely, say on a weekly chart, am I faced with potential overlap and then asking, well, what do I do about this? How do I handle this? So keep the rules in mind and always try to adhere to the rules and the guidelines, don't forget those, as best as possible. Usually, the most likely count is the count that best satisfies the rules and guidelines. Not always, but usually. Now, there are almost always exceptions to the rules, and even the Wave Principle has an exception to the Wave 4 rule, as I like to refer to it, and that is if a diagonal is unfolding. You see in an ending diagonal, not only does Wave 4 overlap Wave 1, we anticipate it. We even expect it to see that overlap. So that's the exception within the Wave Principle. Always seems to be that complicating factor. Now, let me show you an example. As I was looking through the charts this morning, getting ready for the trading day, I came across cocoa. And you can see I'm looking at the July contract here on the daily chart. I'm suggesting that the retreat from 11,526 is a likely flat correction. 3 down for A, 3 waves up in B, almost a double top, not quite, and then an impulse decline, i.e. 5-wave decline in wave C. When I put more detail on that count over on the 4-hour chart, you can see this does look like 3 waves down in A, 3 up in B is pretty obvious. And you can see I've counted here. This was my original count as I labeled the chart this morning because I was rolling cocoa from the May contract to the July contract, so I had to add all the labels. When I added Wave 4, you can see this little warning popped up saying that Wave 4 was in the territory of Wave 1. And I sat with that count throughout most of the day saying, that's okay. And I did count 5 waves within Wave 3, by the way. So it is a subdivided third wave. It is an extended third wave. But at the end of the day, I thought, well, I don't like the structure of wave one. In the morning, I kind of just gave it a broad brush look, a glance, and threw the labels on there. It's probably better counted with the one at the initial low off the high and then wave two. And now we can count 1, 2, 3, 4, and this is probably an ending diagonal fifth. So very nicely subdivided wave three, subdivided into 5 waves. And that fixed the problem with overlap. But I pointed out this example because my original take, just counting inflection points, was to go ahead and label 1 in the original place, 2 with this overlap, and I was fine with it. Now, let me explain that. I'd rather not count the overlap, especially after an extended third wave, as I mentioned before. But you can't argue with the fact, looking at the chart for the first time this morning, that the rally labeled as wave 4 is in a corrective 3 waves. Okay. And the market subsequently fell to a new low. So that is a corrective rally, and it just seems to best fit as wave 4. If I had a count, and this is just generally, if I had a count that avoided it, I would go to that count. And that's what got me this afternoon to go, well, I'm going to move the 1 back there, put the 2 in its new location, and all of a sudden, no warning, no overlap. That's fixed. Now we're looking lower. Maybe wave 5 is done and in place. That's a whole different discussion. Today, we're just discussing the overlap. So I showed an example where at first look, I was willing to kind of stomach the overlap because I really didn't have a better count. In the big picture, I'm looking bullish based on the patterns that I see. I could count a flat correction, likely at an end. The rally off the low does look like 5 waves if you drill down on it. So it looks like the start of something to the upside. So I'm in that mode, bull mode to begin with. I think I can count a possible 335 correction complete. So I want to do so. There's overlap. It's very minor. This is a very volatile market. Maybe I'm trying to justify it, allowing the overlap, but I think it's the best count available. And then under closer examination, I go, well, if I move the 1 and 2 back as I did, now wave 3 is better subdivided and there is no overlap. Problem solved. So there you go. So what about the overlap rule? Try to avoid counting wave 4 overlapping wave 1. After an extended third wave, you probably shouldn't see it because now you're getting out of proportion wave 4 and wave 2 and prior waves. But if it's the best count that you have, you might go with it. But if you do, you need to make the market prove the case. Here, the beginning of the proof is that the rally from the low labeled as wave 2, the end of that correction, does look to be in 5 waves when I look at it, say, on a 60-minute chart. So I have an idea, maybe I should allow for it, or should have this morning, but part of that was based on the market suggesting itself that a bottom was in place and a reversal to the upside was underway, meaning the corrective slide was at an end. Later in the day, I made the adjustment described, and I don't have to worry about the overlap. So you might think that we're a bit hazy there, but that's a bit of the reality of the market. Like everything, there's always exceptions, and sometimes we just have to go with what looks best, what satisfies the rules and guidelines the best. That's usually going to be your strongest count. So I hope I didn't confuse you with this lesson, but it's a great question. It's a basic question, but a great question. Like I said, we get it all the time. And I know in my work in commodities, which are highly leveraged, working from small time frames, say a 60-minute chart, on up, I do have to grapple with the possibility of wave 4 to 1 overlap from time to time. So maybe this clears it up a little bit for you. I hope so. Again, my name's Jim Martens. Thank you for your time today. If you have a question about the wave principle and how to employ it, about its rules and guidelines and how to employ the wave principle, as always, we welcome your questions.